None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. We are live on Monday morning. Another week about to rush by in front of us before we know what happened. Probably one of the slower weeks on economic news that we're going to see for a while. There's virtually nothing coming out. There's nothing significant until Friday. I think consumer sentiment and I think housing. For some reason, I don't have it. Housing starts. So anyway, very, very quiet week ahead of us from the economic news standpoint. From the aspect of earnings is going to be much different. There's about 150 pretty significant earnings. Some of the banks are going to be coming out this week, and there's some other stuff that looks like it's going to be significant. I think folks are focused on GE and another company on Friday that, it's more of a maybe give a view of the economy. The reality is probably see reasonable earnings, maybe some negative guidance going forward. We're continuing to see this market slow down as far as the economy to slow down in the background. And it's interesting if we look back on last week when the Fed minutes and everybody got all excited. The Fed's concerned about the global slowing, so they're going to keep rates in the U.S. to help out Europe. I guess that's what it's all about. The reality is, even if they keep rates low, the lower rates are doing absolutely nothing for this economy, actually. And it's not really stimulating people to borrow at all. I think as we'll see on the housing start numbers, the housing numbers are still pretty mixed, and they're hot and cold all the time. It depends on how you're looking at it. And Mitch, you didn't see anything else out there that we look at today, huh?
No, I mean, it's an unusual day in that this is one of the few days a year where the bond market's closed, the stock market's open, and so there's no real economic news to come out, no reports or anything today in particular, and it's light aside from that after you take in consideration the earnings reports.
Yeah. So maybe that's why I feel laid back, and it's too quiet out there. It feels quiet out there. So anyway, one of the themes that when I was starting to write commentary last night, I realized what was really going on. I saw some comments of some of the Fed chairmen, some of the presidents of some of these different districts come out and talking, Fisher and a couple other guys. And as I mentioned the other day, it was like they're kings. They run the show. I'm going to argue for a while here that ultimately the tail will stop wagging the dog, and the dog will start wagging the tail, which means the market forces will drive the Fed going forward. I don't think they have any bullets left. Today, one of the things I'm going to go through is I want to go through and show you what's going on with these central banks. I think that's significant. I think the single biggest thing that changed last week is that everybody realized that Mario Draghi has nothing. There are no more bullets in the gun. And if there is, they're blanks. The asset purchase program in Europe, the OMT, which is the sovereign debt purchase, is pretty much limited. I saw some news out of Cyprus. They were excited they might buy their bonds. I think Cyprus has, I mean, it's so small, you can't even find the place on the map. So, I mean, there's no significance going to happen to Europe of any means. And the continuation, the only good thing maybe that happened for Europe is that Putin has pulled back a bunch of troops. So maybe, just maybe, he's trying to get the sanctions off. And if the sanctions go off, then Europe's probably going to come around, or at least that's going to be a stimulus if that were to happen. So that's the one negative thing that's lying out there, that if it were removed, Europe would start to look pretty good. Now, would that stimulate us? I'm not sure. Maybe for a very short period of time. One of the things that I talked about in commentaries, I thought if we held certain numbers, we've actually spiked below them, and I'll go through that in a minute for briefly. But if we happen to close higher in a day, we're probably going to get a 2 to 3 day rally. And the one big thing that we'll go through here in a little bit, we did have a ton of new sells again, a lot of them, right, Mitch?
It was, to say the least.
Yeah. But I think a lot of the stuff that we're selling now, with the exception of SPY going out this morning on the opening, most of the stuff is insignificant from the standpoint of holdings that we see you folks having. Isn't that correct, Mitch? I think.
Well, I mean, what I would say to that,
the large cap, I guess the large cap funds kind of.
The large cap space. Friday when we were signing off, we were wondering, what was going to happen to that space, and we sold off 47% of all large cap positions. So. Right. Aside from that, there isn't much, but that's a pretty big move right there.
Yeah, it is. I guess I forgot about those. Both the blend and the growth large caps were big time.
That's right.
On the sell. So we'll go through those details in a minute. I'm going to go over and we'll start digging in on some of the technicals here. And before that, though, let me bring over here. And what I want to talk about here today, I think this is really, really important. And I put out there that the central bank wars are on, and they really are, because the Fed's trying to get to a normalization, trying to get the dog to wag the tail, as I just discussed. And meanwhile, the ECB, Bank of Japan, and even not so much the Bank of England, they're in a little bit different situation. But the Bank of Japan and the ECB needs more stimulus. And when we go through these balance sheets here, this sheet I've got up here is by Cumberland Advisors, and they do a really good job. It's cumber.com if you want to see this stuff. They have a really good update each week. So, but this chart here was so revealing. In fact, I'm going to get off screen to make sure we can see this pretty easily. This here was probably the most revealing part of looking at this. This is all of the central banks put together in one. And this yellow line was the line that just kind of really gave me a gasp. And that is basically all the currency. And what we're seeing is, in spite of all these purchases, the actual growth in the currency is declining, which is very deflationary. And I've been screaming since way back in 2009 that I thought deflation was the issue more so than inflation. And that's exactly what this is telling us here. It's pretty significant as far as everything that's happening. Then the first balance sheet we're going to look at here is the Fed's balance sheet. And you can see about half of the balance sheet is mortgage-backed securities. That's the main, one of the biggest. It's about almost the better part of $2 trillion. You can see these little slivers in the middle are what the central bank does, which is interesting because it's what they normally do is the smallest part of what they own right now. Then you see the U.S. Treasuries. So all of this big bulk of U.S. Treasuries that you see here is what the Fed's been doing to finance all of the crazy deficits and government operations here. So between funding the mortgage market and the U.S. economy, this is what they've been doing. They're at roughly $4.35 trillion right now on this. And could they expand it to another level? I don't think so. They want to see this thing shrink. Their Ginnie Mae fund, or these mortgage-backed securities, are going to, just through pay downs, the best I've been able to figure out, the maturity of these funds are about 12 to 14 years. So if they did nothing, this piece would disappear 12 years from now. On the treasuries, it's a little shorter actually. It's something like 8 years, I believe, is the average. It's not that long. So all of this stuff, by doing nothing for 10 years, will just start to fall off the balance sheet. And then that would give the Fed the ability to expand it again. expanding it from here in any significant way is probably very, very little that would happen. So looking at, I'm going to go to the next bank here. I keep hearing a ding ding. I'm not sure where that's coming from. The European, this is the ECB sheet that we're looking at right now, and that is probably the most interesting. You see, they got up to about 3 trillion, and now they're down to about 2 trillion. So they have room to expand, but it's contracting when they're supposed to be doing QE, and they can't get. This happened with the Fed a while back. They can't get the balance sheet to expand. And in my opinion, this is one of the real issues, and this is why they're trying to do other forms of QE on the ABT program and the sovereign debt program. They're trying to get their balance sheet to expand, and they just can't get it to go. And this is a big issue. I think the one primary thing that changed with the whole market sentiment last week is the realization that there's not much they can do to make this happen. So you can look at this is the liability side, and it's showing some declining there as far as that goes. Here's the Bank of England. You can see they're also at 4. Everybody's around 4 trillion. This is flattened out substantially. UK is actually doing pretty good economically from it. Their housing market has done really well in reviving itself. But you can see this huge piece here is once again the mortgages. So it's been financed once by the government, and we're going to just go down. I want to look at Bank of Japan, and you can see this is the one that is probably the most vertical, and they have got the pedal on big time trying to get. They want the yen to go down. The Europeans want they want to see the euro decline, and the U.S. they want the dollar to be strong, but they don't want it to keep going up because it's messing up the pattern. And this is where the war zone's more about currency than it is the balance sheets. And so everybody wants a lower currency just so they can actually try to get some more competitive costs going on. There's a lot of issues across Europe with competitiveness, especially with the wages that are in Southern Europe versus Northern Europe is off the map in comparison. And then we saw, what do we see on Friday? We saw Finland get downgraded, which isn't that big a deal, but we saw France, and France has got massive amount of trouble going on economically. They can't get anything going. Meanwhile, anybody with money is getting out of town. There's a mass exodus going on in France right now, just trying to get out of there. A whole lot of folks going over to the UK and going to London. So it's they've got their hands full, and they're the second largest economy in Europe. And meanwhile, Germany is slowing down, and other elements are coming into play in Germany. They are, as always, the biggest economy, but they are driving this lack of competitiveness against all the way through Europe. So what we're seeing here is a big struggle to try to get Europe back on track. I think these guys have big trouble. There's a lot of debate going on over there right now on how to fix this issue, and I don't think it's very fixable, if you will. It's interesting because if we even go to even the Swiss got involved in this game. So all of the Western governments have expanded their balance sheets massively 5 times. So even if they tried to expand it again, maybe they could go maybe one more time. I don't think it's going to matter. The reality is that normalization will happen, and I think this time is a lot different from the Federal Reserve standpoint and all of these central banks. I don't think they've got a lot. It's got to be up to possibly other elements coming directly in Europe from the government, from the individual governments trying to get some stimulus to go, let's take hold. I'm not sure what they're going to do. It looks like this thing's going to roll over. They're talking triple dip in Europe, and we're going to see. I think we're going to see things slow down. And if the Fed they're not going to lower rates. They're going to keep them low, and they're going to get out of this buying of treasuries. They want, like when we were looking at that spreadsheet. Let's just spin all the way up to the top here real quick. When you look at this spreadsheet, they just want out of this game. I'm telling you, they never wanted in it. They got in it. Hank Paulson and the gang got them into this game through the Treasury, and now they just want out. And they want to see this balance sheet get down to something normal. If you look all the way back here in 2007, the balance sheet on the Fed was $900 billion, not even $1 trillion. Now we're, like I said, we're 4.35 trillion. So this is a big issue, and it's really about the currencies. And we'll look at the dollar index and some other things. But I think that it's very possible that we're going to see the dollar top out for short term, which is going to cause some other gyrations to happen. So let's go ahead over and get involved in the technical side of the market. Start looking at what's going on right now. We're looking at, from a standpoint of the market now, we're down 622. We're trading below the infamous 200-day moving average, the 40-week moving average, which we'll look at here in a minute. Let me get some glasses on so I can see. And we've been struggling. We've bounced a couple times. We're trading under this number. We went 1902, 1903 a couple times intraday, and it keeps failing. Let's take a quick look at the PPMs here. And this is significant, I think. Let me bring this up here so we can all see it. The PPM1 is minus 0.39, PPM2 is minus 2.0, and then minus 0.6. So all of these moving average, you can see here, I talked about this occurring last week on last week's Monday show and on Friday continuation. We saw this 10-period moving average slicing through all three of these. So this is a big crossover, and while we're at an extreme and momentum is kind of stalling here, and minus 0.38 tells you that this is going to be a significant barrier to get above, and this average is declining roughly by, see what it's doing per day. It's declining about 7 points per day. So right now it is at the 43 level, so it'd be 35 and around 28. So it's going to be tough. I mentioned in commentary about a 1925 number. It's going to be sort of tough to get above that 1925.50 is going to be a key area to watch, regardless of what kind of bounces we get. We're trying to rally the market a little bit again here, and we'll take a look at the futures and some other things there in a minute. We'll run through the gamut of the daily and weekly charts here real quick. Weekly has gotten pretty negative. We're not quite in a downtrend mode, but one of the things that I discussed the other day in occurring, which is what's going to happen, is the 10-week moving average is going to decline below the 21. We're right now 1970 and 1962. This probably isn't until next week, and it would take a substantial rally to turn this around, to turn these averages around. If you look back and count back 10 weeks ago, the prices dropping off, they're actually pretty stable. So all the new prices are going to pull the moving average down toward the levels where we're trading now, toward the 1902 level. It's going to take probably about 2 to 3 weeks to get this down, but it's going to represent some pretty substantial resistance overhead at this time. And you can see over here on the right-hand side, moving this out of the way, let me go full screen here, as you can see over on the right-hand side that we're penetrating through this 40-week moving average. And right now that 40-week moving average is, get that up there, 1908.56. So it's still rising slightly. It's up 0.8, and so it's got a slight slope to the upside. So 1908.50 is going to be, as long as we stay below that on a closing basis coming in on Friday, we're going to continue to see some negative output. A couple things in commentary that I talked about I think are significant to address, and I'll show you where these numbers came up, where they came out at, but it's most likely, I said we're going to go to 1891 to 1871 area. Today we've been to 1890.67, so we've already satisfied some of this downside. This is off the short-term charts, off of the hourly and the daily graphs. That's where we should have went. We bounced pretty good off of there. We're about 11 handles, almost 12 handles above that right now as we're trading 1902.15. I think there's a pretty good chance that we're going to close back above this 1905 level that everybody's watching. The markets want it to be there. They're not ready to go below the 200-day moving average or the 40-week just yet. I think we get a little bounce, and we'll find out this answer toward the end of the week, because everybody's going to be waiting for earnings since there's nothing today because of the Columbus Day holiday. Banks are closed, interest rates are closed, and all that. The reality is that we're going to see kind of a wait and see. Wednesday really gets to be some pretty good earnings coming out. Thursday and Friday will drive this market. So it's going to be about earnings this week. There's not a lot to get in its way. But the patterns are unfolding. You can see that we have sliced through all three first and second derivatives over here on the far right. These PPMs are declining, and they're showing some acceleration to the downside. And there's very little, once these things start to happen, these moving averages, this intermediate chart moves a little faster, but it takes several weeks to turn this around. So it's going to be interesting to see how the next couple of weeks come into play. With the close that we got on Friday, we should see at least 2 more weeks down, and a possibility of as many as 5 before we'll see a significant low. And like I said, the very short-term target is 1891 to 1871 area, and we've already hit the first segment of that. So we may see a little bounce there. We'll see how the rest of the day. We'll take a look at a couple more charts. So this is the big chart. I'm going to get off screen here just so make sure nothing's covered up. I don't know why my, excuse me 1 second. There we go. This is the big chart. This is the monthly graph, and we're looking at PPM1. You may remember this was 120 not that long ago. It is now at 0.29. The PPM2 is 109. It was at 126, and now PPM3 is 0.93. And what's happening here is that deceleration of the angle of attack that I talked about. The 21 and 10 month moving averages are on a collision course now to run into each other, and it's going to take several months for this to happen. So this is not going to be something that goes really fast. As I bring up the numbers here on the screen, you'll see the 1909.17 is the 10-month moving average. So we're trading below that at the moment, and that is going to be the key number, but we're midpoint in the month. We're the 13th of the month, so we're about midpoint. We'll have to see how this thing plays out, but if we can close under that at the end of the month, that's going to be pretty significant. Here's the 1781. That's the 21-month moving average, and then the 40-month moving average is 1573. My expectation is that we will touch both of these averages sometime in the next 4 to 6 months. And that is almost a given for sure to get down to the 1780 number, and then ultimately the 1500 number. That might be as many as 8 or 9 months out. But once this thing starts to get rolling downhill, it will go pretty fast. As I've been talking about over the last several weeks, I really don't see any reason to own stocks right now. There's just, you look at our database now at 21.56% bullish now. And Mitch will be covering the database here in a few minutes, but it's pretty substantial from the standpoint of where we have liquidated down to, and the implications of that we'll go through when we cover the database. But you can see on this, if I go here just for expectations for the month right here, this is the pattern finder and the range finder for this chart. We have traded down below on a monthly basis below the extreme of 1900.22 with the low here of 1890.67. So we have exceeded the extreme already for this month, and it was a pretty good range. We had a range of 2044 to 1900. So we have actually gotten below that range already, which is telling us that there's some further weakness. The next month's range, depending on how we close, is likely to have some of these lower 1800 numbers. There's some support between 1818 and the 1781 area. That's going to be a range that will be targeted as this thing unfolds over the next several months. And it could be, once we get through this level, there could be some acceleration. But I suspect here, as we go through some of the shorter term charts here in a minute, that we're going to see a little bounce. We're going to try to rally to see if we can close higher today. If we do close higher, then we're going to challenge at 1925.50 level in the next couple of days anyway, as some of the pressure comes off. The buy the dippers maybe are showing up this morning. Anyway, so let's go and take a look real quick at the dollar index, because I want to cover that real quick. This is ground zero for this is the war zone here. And you can see this is the monthly. We're finally starting to get a little bit of frothiness, but I want to go full screen here and take a look at the intermediate or the weekly. You're finally starting to see some sort of wedge setting up here, which tells me there is a likelihood of this thing starting to show that this is going to be here. So just from the Elliott standpoint, this is probably wave 3. We're going to get some kind of move like this, and then we should see one more high. And I've talked about this before. The 88 level, between 88 and 90 is going to be pretty substantial move as far as that point goes. If we look at here, you can see this is the old highs that we had back in July. We've exceeded that, and we're in trend mode. Plus 0.55 point on PPM1, plus 0.34, and then 1.5. So 2 of the 3 averages right now are in a trend mode. The only thing that's happening here, I want to point out, is that we're not getting acceleration in the 21 and the 40 period moving averages. And typically, once a market moves above these averages like this, it usually will get more of an acceleration. We're not seeing acceleration, which tells me there's a possibility that this pattern could fail, but we won't know for probably 6 to 8 weeks. We're going to have to watch this pattern unfold. But at the moment, I think we've kind of hit a top. We're down 0.5%, and I think this is ultimately going to affect some of the other markets, and this may be a little bit in here for some sort of rebound at this time. Let's go real quick down to the daily graph so we can see that. You can see this pattern a little better. We're starting to see some rollover on the moving averages. We could come down to 84, but this range is going to be a consolidation range on the dollar. So I don't expect to see a lot of things going up. What I do want to pop up here really quick is we're going to put the euro here. I want to go to the weekly on the euro. And the euro is in a pretty steep downtrend here, but I think it's about to find a low somewhere around between 124 and 125. So this is going to start to show some rebound as we go through there. So we'll have to watch this pretty closely. But this is the primary place where the war is going to be fought, is in these currencies. And I think for the moment the dollar is going to flatten out a little bit, and some of these currencies are going to come back. We could see the euro come back as far as maybe 130 all the way from 126, which isn't a lot, but it is about 8, maybe 7 or 8%. We could see a rebound here. So it's going to be, this whole configuration that we're watching unfold right now is going to be somewhat interesting to watch how it unfolds, how it affects our markets. You can see now we've now turned positive on the S&P. We're now at up 1.84. We're at 1907.97. So I suspect, like I said, we're going to try to close a little bit higher. Let's go over to the futures here, and you'll see there's a high cycle coming in about 40 minutes from right now on a 5-minute chart. It looks like we're going to see probably a high come in there. The hourly graph is starting to bottom out as well. We had a cycle come in here earlier, right here. Now we're looking at the next cycle, which should be a high cycle. It should go high to low in this particular cycle right now. That's not until well after the close, and these are 24-hour charts. So we're probably have seen the low of the day. We're now at 0810. So that's really going to be, it's going to be interesting how we come out, we finish the day. My bet is at the moment we're probably going to close above the 1906. We're going to close higher in the session. We'll set up a 1 to 2 day rally. We'll take a look at this as we get closer to the end of the show. So I spent about 30 minutes going through this stuff. I'm trying to see if there's any. Oh, this is one thing I did want to look at. It's interesting because the European markets actually came in lower, came in about 0.5 to 3/4% lower last night, and actually are trading higher right now. But look what's happening to my two favorite international graphs. This is so I spread this out here. This chart here is the EFA. We're starting to see this graph turn around a little bit. And like I said, it'll be interesting to see if somehow the Russians can convince everybody it's okay to take off the sanctions. And trust me, Europe really wants the sanctions off because it's killing them. It's really killing them. And if there were full sanctions on with Germany right now, it would take 1.4% off GDP of Germany. They do a lot of trading. Russia's a big trading partner with a lot of Europe, but primarily with Germany. So it's really, they're taking the biggest hit in the entire Eurozone on this whole sanction thing. But let's take a look at the emerging market. It's a little different. It actually shows a little stronger move. So all of these are starting to change. Like I said, a spread like this doesn't mean that Europe is going to go up and we're going to go down, but what it means is a relative performance. And I believe that a lot of things, when Mitch goes through the international scene, you'll see a lot of these markets are down way more than ours and have been going down for a while. So we're likely to see some of these emerging markets really start to turn around. Some of them have been hammered down pretty good. So even if they just stabilize and we continue to go down and we hit these numbers I just talked about in the next 4 to 6 weeks, that's what's going to happen. So, all right, I'm gonna get off here for a minute. Let Mitch take over, and anyway, Mitch, let's go ahead and get going here.
So, first thing to talk about is the position-led database. As we've looked over the total sells that have come across the BPM database over the last 6 weeks, we've seen that we've actually liquidated 9,000 securities when it comes to net activity over the last 6 weeks. So we've seen a massive amount of movement just in the last month and a half. This week was more of that story. As you can see, that we're now down to that 21.56% level that we talked about during commentary. It's funny that just last Monday we were talking about how we were at the 29% level. We were targeting that 22% level. Then a week later, here we are. So as you can see, we had some fairly large movement this week when it comes to the total database. So let's actually go through that and we can see what has taken place. On the stock market side of things, it's again more of this broad-based selling. A lot of this has to do with the capitalization of the companies. We're seeing the small cap and mid cap further get hammered. The large cap, though, is starting to finally catch up in the drawdown activity. So we are seeing some movement in the large cap capitalization companies. So what had been fairly isolated to the small and mid caps have finally spread to the large cap companies as they are starting to see some pretty substantial pullbacks as well. I think the real story this week, though, is on the mutual fund side of things. And you're going to see that in a couple key areas when it comes to mutual fund. going down this list, first off, we had some more selling in allocation funds. Again, not a lot of people use those allocation funds. The alternative funds also had some activity, but at this point, most of that activity is in these market neutral or multi-alternative type positions. So you're either seeing the inverse positions go long at this point, or some of the more conventional alternatives, if there could be such a thing. Those we're already fairly defensive on. So at this point, there really aren't a lot of areas that are long aside from your traditional municipal bonds. And we did talk about last Friday how we were waiting to see what would happen on the taxable bond fund side of things. We have seen some traction this last week when it comes to the taxable bond funds in the right places, the places that you would expect to see, which is intermediate government, intermediate term bond, as well as the short term and short government bonds. So we are seeing some more rotation in those bond spaces. The real news this week, though, and you're probably seeing this in your portfolios as well, is the U.S. equity fund space. And this is what we were talking about earlier. 47% of all the large growth mutual funds that we track in our database had a sell this week. So if you had some sells coming into today, really it's one of the best things that could happen today is that we close slightly higher in the day. That's a great pricing for these mutual funds. Get out at a nice little bump before the decline continues to spread. But at this point, what we're seeing is almost all traditional style box based portfolios are 100% cash or pretty darn close to it at this point, because all the style box positions, almost all of them are flat at this point. You can see only 10% of the small growth positions are long, and now surprisingly, that is the area that has the largest concentration in that because of all the selling that we've seen now in the large cap space.
Real quick, Mitch, I wanted to bring in something here, because one of the things that are happening with the database, the fact that we've moved into this, especially in like all our global equity strategies going to 100% cash, every week that goes by and we stay probably under 1960, I'll try to come up with a number on Friday, but as long as we stay below 1960, there's not going to be even any chance of any upward momentum building or even flattening. So as long as we're below these levels, we're going to continue to see a deterioration of momentum, which sets the market into a more vulnerable situation. And I looked at all the stories, and just looking through stories this morning on CNBC, every one of them was why the market's not going to go down, why it's not going to go down, why this, look for a bounce here, look at all this stuff. So all the stories that the CNBC tends to be, they're very biased, and they're always a long bias in CNBC. It's like watching MSNBC. They have a bias, and it's like they always have this long bias. And I swear to you, can see what kind of market day it is, whether you just tune in, turn the sound off if they're smiling or if they look really serious. So, but it's always about where to buy on that whole dialogue on that show. And when it is really negative, even going back, I remember in 08 and 09 when things were pretty rough, it was just like, whoa, man, another day, just another one of those things. So we want, that's, I guess, the dialogue you want to see around this market. And, so that, I just wanted to bring that in, because what's going to happen with the database at 2156% bullish, there's just so many symbols. It's going to take literally weeks and months for this thing to play out. Even if it stabilizes here and it never was a new low, it's going to take a while for this thing to get into a place where we can start to see buying coming back in, and that risk on would be a big trade again. So I just want to bring that in. Sorry, Mitch.
Well, Bob, you had mentioned those moving average levels that we're targeting at that 1781 level, which would be another 6% pullback in the market.
Right.
1573 level, that'd be a 17.3% pullback from where we're at right now. Even if we don't hit those levels and we just go sideways for a long time, that's really the defensive stance is where you want to be at this point in the market, where the market has hit a top. There isn't any strong trending direction to the positive side. There's no reason to own this market.
Well, think about this. When we're looking at the moving averages and the monthly graph a few minutes ago, it's going to take months for that thing to lose enough momentum to get to these numbers, these 1780s and these 1500. It's going to take months and months. This is the beginning, and I've talked about this over the last, I don't know, maybe 2 months now, that this is the beginning process of a top. And it's just a matter, what we don't know is whether it's a gradual top or we wake up one day and we've got 250, 300, 500 points down on the Dow Jones and everybody's selling, and there's some mini liquidation more significant than what we saw last week. Was not that big a deal, by the way. We saw massive amount of volatility swings, but net there's been a lot worse weeks on the records when things are happening. And if you look at the backdrop, is there anything really super negative? No, there's not. It's just that the market sentiment is turning, and this is sort of like that monthly graph's like turning this big boat, and it's just going to go real slow.
Yeah, and I've used the phrase for the last couple of years that we've, or at least I have been. You could take whatever opinion you want, Bob, but I've been more
sure
reluctant bull because even though the market's going higher, and you can look at all these fundamental reasons why the world should be going to hell in a handbasket, it didn't matter. The market was going higher, so reluctantly I was invested. At this point, I would like to caution advisors on the verbiage and how they portray the market going forward, because it can be really tempting, when you're very defensive, to say the market's going to just have a massive crash. Well, even if the market doesn't have a massive crash, it's still appropriate to be very defensive at this point. But you want to be careful that you don't set the expectations too high or too low as far as where the market goes from here.
Yeah, that's a good point. Yeah.
Yeah, at this point, we're waiting for the trends to really emerge one way or the other, and there's no reason to be long the market while we wait for this to happen.
And as we went through, and that's why we go through the three levels, the daily and the weekly and monthly graphs. Monthly is just beginning the cycle. The moving averages haven't even cranked over yet. Matter of fact, we're trading right at the 10-month moving average, which is this 1905 to 08 range, depending on how it changes on a daily basis. So, so this is, you want to be careful. The fact is that there's more risk in the market. So I look at whenever I get out of a position, I don't care what it is, what stock or mutual fund or whatever it is that I own, I get out of it for one reason only, is that there's more risk in holding it than there is in owning it. And that's always the case. So I'd rather be on the sidelines, and yes, I'd rather pay up to get back in if they can prove to me that's the right thing to do. Probably 8 times out of 10, that's not how it works out. But sometimes it is the way it works out. But in this case right now, I have no idea, and maybe that's, other than, the expectations for the Fed. I think the entire market has been built on expectations of the Fed floating this market higher and the economy doing okay. Well, if the Fed's not going to, they have nothing to go. If my assumption is that the dog is going to start wagging the tail again, then we've got a bigger issue going on here from a market sentiment and ultimately from a market direction standpoint.
Yeah. I had an advisor ask me a week or so ago, where's a good place to invest at this point? And, looking at something like this weekly research chart, I think this just goes to show you there really isn't a whole lot of places to invest in right now that's worth it, that's worth the risk. The weekly research, for those that are unfamiliar, this is sort of like a pre-built watch list of sorts. It has various different ETFs and mutual funds in some key areas. We have a commodities section. We have a global markets section showing you the various different iShares ETFs that are out there that show single countries. And then lastly, we also have at the very bottom of this, the components to the various different flavors of the global equity strategy. And as you can see, there's a lot of these gray boxes. Those gray boxes signify that we're flat the position. The light green signifies that we're long the position. If you go up and down that chart, you're not going to see a lot of green at all. What you're going to see is a lot of gray and a lot of red. Red signifying that we're exiting that position this week. That's the case with SPY today. And then the rest are going to see gray boxes. We're just flat those positions. There really isn't a lot of opportunity to invest in at this point in the market as things are going through the process of getting reset. We talked internationally about what's taking place over in Europe as well as a few other countries, a couple areas. If you pull up the globe at a glance, I think this is just some good perspective for advisors. If you haven't been paying attention to what is actually taking place in these foreign markets, this is a very easy to use tool to do that. Here I pulled up the globe at a glance. If I go over here, there's this box over on the left-hand side that allows me to zoom in. So if I actually just click and drag and draw an area on this chart, I can focus in on Europe. And if you wanted to, either in your own investment committee meetings or if you're sitting down with the clients, you want to give them some perspective what is taking place in all the places that are making news right now. This will tell you the story that you need to see. Russia right now, they're down 24% on the year. This is just year-to-date numbers. Germany's down 19%. France is down 13%. We're seeing nothing but red for the most part when it comes to Europe and Russia. So all these players that are making news right now, they're not showing any signs of a bottom. Maybe we're starting to see a little bit of movement on the spread chart, like Bob had pointed out. And maybe the sanctions will get lifted as we go towards the winter, because obviously Russia wants to sell the natural gas and the oil to the European countries so that they can actually produce some heat going into this winter. But it will be interesting to see how this continues to play out when it comes to these international markets.
And by the way, those of you thinking that the drop in energy is going to help Europe, they have so many. You think we have taxes on our gas? They have some serious stuff going on. There's just no help for these guys. And it's just, there's no way that the prices are going to do much. So they've got them pretty much locked in. There's so many different government levies on just about everything. Number one being almost everything, not everything is imported. So it's a much different situation over there from the standpoint of what's going on in energy. That's for sure.
Yeah. One of the other things I wanted to dig into, changing gears a little bit, a couple years ago, we did a couple different case studies. We did a stock basket case study. We also did a MPT style portfolio case study. And time has passed, and we've somewhat forgotten them. At least we haven't mentioned them to the advisors at large. Every now and then an advisor will come to us and ask us some questions about some of the dynamics of creating a stock portfolio or building an MPT style strategy for their practice. And so what we've done is we've actually revamped these case studies. And so I just want to point this out to you folks that are using VPM, that you can see this within the research section of our site. So if you go up in the Connect site, under research, you'll see that we have a new section as of today called case studies. And what these case studies are just taking a couple different ideas that advisors have come to us, or ideas that we've thought about over the years, and it just gives you a prepackaged case study, a what if you were to try this different route. And so some of the ones that we've put together, and this list will continue to grow as time goes on. We've done the research ourselves to see what would this look like if you were to use these strategies within your practice. And so I just want to touch on them really quickly today. We'll likely go into this more in other shows, but I want to let you know that these resources are there. So for example, a Dogs of the Dow strategy. This is something that gets asked about every now and then, where an advisor will stumble upon the Dogs of the Dow website that talks about owning these 10 high dividend paying stocks, that you reset that list on an annual basis. What does that look like in VPM? What we've done is we've created these portfolios. We've actually created them within the Portfolio Expert platform. So any of those folks that are watching right now that are expert users that have Portfolio Expert, if you go out to the subscriptions, you'll see these already. We'll bring the classic versions over to 2.0 as time goes on. But for right now, this is all available within the Portfolio Expert platform. You could also download these case study fact sheets on the Connect site. But again, there's more details in this than probably what we have time to cover today. But I just want to let you know that this is on here. We have 3 different case studies. We have the Dogs of the Dow, which again is using just a basket of 10 stocks out of the Dow 30. There's the First Trust Target 25, and this takes the idea of a basket of 25 stocks rotated annually. And in this case, we're letting the First Trust professionals that are going out and creating these UITs, we're letting them go out and pick the stocks, and we're just using VPM system with it. And we've shown in these case studies what the conventional, the institutional version, if you were to go to them directly, the source, how this would have performed over time. We've also created versions of this within VDOS, which uses some of the same weightings that they recommend if they happen to overweight or underweight positions, but still use VPM's buy and sell logic on it. Then lastly is the classic, which is using our allocation factor, our buy and sell signals, just letting VPM control all the activity on when to get in or out and how much to get in or out of each of these positions. So I'd highly recommend for you folks to take a look at this, especially the First Trust Target 25 and the Goldman Sachs, because those are probably some of the best examples of what we run into every now and then, where someone goes out, finds some other idea that's out there, and they ask us, what would it look like if we were to do that with VPM? The Goldman Sachs strategy is a MPT style strategy. It's a collection of, I believe, 11 different mutual funds. These are all Goldman Sachs mutual funds. And we have variations from a buy and hold MPT strategy to a what I'd call an active allocation strategy, where we're still using Goldman Sachs weightings. We're just putting our own buy and sell logic on it. And then last, the classic strategy, where we're simply using Goldman Sachs funds, and that's about it when it comes to the original source.
Hey, Mitch, why don't you show them how to get to those fact sheets and discuss that a little bit?
Yeah, so in the case of this, we always put out these fact sheets at the beginning of every single month. You'll see over on the right-hand side, we have the case study fact sheets. If you just click on either the folder here or this little link right here, it will actually take you right to that case studies section. So in this case, we have the 3 different scenarios that we put together, the Dogs of the Dow, the First Trust, as well as the Goldman Sachs. If you just click the download button, it'll open up the PDF, it'll save it to your computer or open it up right away. And I'll have the same type of fact sheet that you're used to seeing in all the premier strategies. But in this case, it's all about the case study. So we have a quick write-up of what went into this case study over here on the model strategy section. And then it gives you the numbers to look at when it comes to the various different versions of it. So in the case of the Goldman Sachs one that we have pulled up right now, this blue area chart right here is the classic strategy. It's the recommended strategy, if you will, of the case study. We also have the S&P 500 and this orange line here. The original institutional version, this is if you were to go to Goldman Sachs directly, use their weightings, use their funds, and use their quarterly rotation strategy. That's what you would see here, this yellow line that's underperforming the S&P 500. You can see that for all their efforts of diversification, of the quarterly rebalancing or tactical rebalancing, however you want to refer to it as, they haven't been able to keep up with the S&P 500. This is using their most aggressive strategy, their equity growth strategy.
I guess I should defend Goldman because they're not trying to beat the S&P. It's an allocation strategy. And any time that you go, probably a better index to go against would be some kind of the 60-40 or something like that. Because really what they're trying to do is they're trying to mitigate risk through that strategy. But the interesting thing is, that's the point of VPM Classic being up there, is we mitigated a lot of the risk and didn't allocate the way they did, and was a much more dynamic situation, and we're able to add a lot of value versus just trying to diversify risk away, which in the end acted just like the S&P. On the downside and on the upside, it massively underperformed because of the goals of the strategy. And that's one of the things that we were talking about, when we were talking about the Peak Capital offering with the third-party management with the VPM strategies, is we helped build the 24 stock strategy, and the goal was to drive down our lane, never get across the other lane, or do anything that would cause any kind of I guess, risk that would put us off the road ever. So we just want to stay in our lane. We wanted to go the speed limit. We weren't trying to beat anything, but just try to make it get from where we are now to somewhere else.
Right. Yeah, and you're right. I mean, you're correct when you say that Goldman Sachs isn't necessarily trying to beat the S&P 500. That is one of the joys of our industry, is, at least as of late, it seems like everybody's looking at the S&P 500 and wondering, can your strategy beat that? And
that's why I was just protecting you. You were sounding a lot like a retail investor. So,
The only reason why I bring that up is because that's the traditional scenario that
exactly. No, I get it. I just like to always just set you in some kind of awkward moment when we're on the show. No, seriously. But that is what they're trying. They're just trying to do. A whole point of MPT is to try to mitigate risk through diversification. And the odd thing about it is it tends to have all of the downside risk, but never participates on the upside. In our classic strategies, we alleviate half or more of the downside risk and participate with probably about 80% of the upside. So the difference is when you start to mitigate a half or more of the risk, all of a sudden that's why the top mountain chart looks like it does, because we're able to stair step that money forward. And so I know a lot of you have focused on, doing some sort of allocation. Sometimes you take our symbols and you're still doing allocations. Well, you end up looking like Goldman versus doing just a classic. So, we're always going to defend what we do and what we do best. And when we put these together, none of the books are cooked. We're glad to open up the entire book, right, Mitch? We'll show you how we did it, why we did it, every little detail, and all of those things, because it's not about that. It's about really contrasting the different styles and the ways to handle assets. And that's our entire message, by the way, is handling these assets in a different manner to mitigate risk through the use of cash and exiting these strategies, and instead of always trying to be in the markets and trying to diversify away risk through that. And it's just, it's always the best way to moderate gains and all the losses that I know. So
I know we only have a couple minutes left, and just sort of in that same aim of things, now is the time where we tend to get a little bit more questions from advisors about the inverse positions. And I mentioned that we had still a fairly healthy position in those inverse positions. One of the things that I want to caution advisors is, at this point, this is where we take risk off the table by liquidating the long equity positions. This isn't the time necessarily to go into the inverse positions, because in that case you're still applying risk into the scenario as opposed to bringing risk off the strategy. So if we do go into another bear market where we go down another 11 or 20%, whatever the case may be some opportunities over the next few months to go into some of these inverse positions. But again, that's applying some sort of risk onto the portfolio as opposed to taking risk off the table.
Well, in the last couple minutes to go, I usually come back on here and go through some of the elements from the standpoint of where we are and how we're going to close for the day. So let's go ahead and go back and do that. And I think we want to start talking. We're working on, like I said before, just about every strategy known to man that makes sense, putting them together in our premiers and some other aspects of doing your homework for you, and so that we can do these things in a laboratory environment and bring out the best of the best. So let's take a look real quick here, and you can see we kind of peaked out here. We're at 1907.77. The futures are off the highs right now. We very close. Here's this next cycle about to come in, so we're pretty close to having that next cycle come in. Whether it's going to be a low and there's another ramp up, it's going to be hard to say. I think it's going to be hard to find anybody really to buy in the current situation from the standpoint of how the market's configured from, with the Columbus Day, with the banks being closed and the bond markets being closed. There's just not enough to anyone's going to make any big bets today either way, I think. So we're looking at probably a stable close. I expect that we're going to close higher in the day, but I don't think it's going to be by much. Big number, 1925. That would be off the map, crazy, especially after trading down to 1890 this morning. So look for this market to probably stay above 1905, which is the magic number, the 40-day moving average or 200-day moving average, and the 40-week moving average is 1908. So we'll see how this thing all plays out the rest of the day. And as far as the week goes, I expect that we're going to chop around in this range. Will be 1925. We've established an 1890 low. That's going to be a pivot point now. I'll be talking about that in commentaries that unfolds. So we're pretty much done for the day. Hopefully you enjoyed today's show. Please comment. Please send us comments, ideas, suggestions, anything that you have. We really very much want to know what you're thinking of the show. We've had some great feedback. We've got some regulars who are on the show twice a week for the most part. So let's go ahead and, from the standpoint don't know if you had any final thoughts. It's time to get off, but you have any thoughts, Mitch, at all?
Just if you have a sell in the large cap space, sell it today and reap those gains.
Yeah, absolutely. Yeah. So anyway, folks, have a great rest of the week. We'll talk to you through commentary for now. If anything major were to happen, then we would come in and do a special show. For the most part, we're going to continue with this Monday, Friday. It seems to work for all of us that have gotten on a routine to watch the shows then. So it works really good. Anyway, have a great day, and we shall see you all soon.